like to know the secret to enjoying vacations? Pay for everything up front. I'm not kidding. My wife and I used to take these European trips where we would do it all, we'd arrange all of our stuff. And then we get, you spend the money on the airplane, you get there, but then everything that comes up, you have to make your decision on how much you're going to spend. And it really eats into the joy of the vacation. So if you can find a way to vacation to pay for everything up front, like we took a cruise back in October, and that was really great because I didn't have to think about, so there was no worry about spending, thinking about spending money on the trip. Now, is it more expensive? Yes. But we're paying for a trip right now for the summer of 2026. It'll be totally paid for before this year's even out. And so at that point, oh, for shame, she's a little late. This is becoming a habit, not a good one. Okay, so anyway, by the time we go, we won't have had to think about that at all. Any questions?
Where are you going?
Where am I going? So this time it'll be on the Rhine River in Germany. All that medieval stuff. And we went to the Mediterranean the last time around, so that was a lot of fun. Yeah. One thing I've learned is be in the moment. Too much of the time people are trying to take pictures. I see these Chinese tourists, and that's all they do. I'm like, do you even remember being there? Because all you did was. Okay, so back to the story. Options in corporate finance. Let's talk about what an option is. An option is the right but not the obligation to do something. When you got accepted to Missouri State, you had the right to attend, but you did not have the obligation. Someone asked you to marry them. That's an option. You have the right to marry them, but not the obligation. So, options, we'll get to this, but options have value. And we're going to see that there are lots of options in life that we don't even think about as options. Okay, now, when we exercise the option, it's the act of buying or selling the underlying asset. So, what an option in finance terms is doing is giving you the opportunity to buy or sell a particular asset at a particular price on or before a certain date. And we're going to agree on that price today. Now, only one person in this relationship has the option. If I buy the option for you to do these things, you do not have the option. I do. You have to do whatever I decide. If I decide that I want to buy your shares with my call option, you've got to go along with it. If I decide to force you to buy these shares with a put option, you have to go along with it. And so only one person in the relationship has the option. The strike price or exercise price is this mutually agreed upon, bless you, mutually agreed upon price that we decide in advance. Now, let's talk about if I were going to represent the strike price with a letter. What do you think it would be? Okay, we could do X. Anybody here play baseball? Ms. Wilson, what is a strike in baseball?
It's when you throw within the strike zone.
I know what that is. What's the letter do you use to represent the strike?
Okay.
K. Okay, so you typically. It was like pulling teeth. I didn't want a definition. I was talking about what letter, right? Okay, so we're either going to use E or K, so that's going to be what we use. Then we have expiry or expiration date. Now, I am so fortunate that I have two native English speakers in this class. English, not this American stuff. What does expiry mean?
That's the other one.
Okay, so my other British person, what's expiry?
When something ends.
Yeah, so I would pick up stuff when we were in. My wife and I always go to grocery stores wherever we go, and it's a cultural experience, right? So go to the grocery store wherever you go, and you pick up the stuff. And there's a couple of things that'll freak you out. Number one, they put the day first, then the month, then the year. Number 2, instead of saying expiration date, it says
That's fine.
expiry. Just expiry. So expiry is just, oh my goodness, this did not go well. I really expected you guys to know
I've
this.
never noticed that before.
Well, you should, next time you're home, check it out. Yeah. It is also confusing to Americans because the date can be switched. So if it was October, it's not bad until October 2nd. You might think it was bad on February 10th. And suddenly you think you've got rotten biscuits and you don't. Okay. So expiry is the expiration date. You may also hear it called expiry by other people. So let's talk about European versus American options. A European option can only be exercised at expiry. A European option can only be exercised at expiry. American options can be exercised at any time up to expiry. So with the European ones, it's on that day. With American options, it's on or before that day. Now, I'm going to show you that with just really strange little exception, it's never optimal to exercise an option early. It is never optimal to exercise an option early. Instead of exercising it, we will sell the option to someone else. Instead of exercising it, we'll sell the option to someone else. Now, let's take this thought about never being optimal to exercise an option early and apply it to your own life. How many of you, when you get a job offer, you just read through it and then you sign it and you get it back to them just as soon as you can? Mr. Olses? Will you confess? Yeah, he did that. Okay, and then you would too. Okay, so here's the deal. What about if they said, we need to hear from you by the end of the week? What could happen in the meantime that would make it good for you not to have accepted that job? Yeah, what if you got a better offer? And it's exactly the same with a proposal of marriage, right? You could get a better offer along the way. Does that make sense? So it's never optimal to exercise an option early. Even though I plan to retire July 31st, 2037, I will not turn in my paperwork any sooner than I have to. It's not optimal to exercise an option early. What could happen that would make me want to extend my time here?
It's a big cost.
Say again?
Like there's a big financial cost to you somewhere.
Yeah, well, let's assume that there's a big financial crisis and all of my stock becomes worthless. What's the only thing I have left?
What if the offer gets passed to someone else?
Oh, well, see, that's the neat thing about, the job offer I was talking about. They have to hold it until the due date they put on it, right? They told you that you're going to hear from them by the end of the week. It's not like they put these things out and say, whoever responds first gets the job, right?
Maybe they are also wanting to, like play around.
Oh, everybody does, right? So when we're hiring new professors, we made the mistake one time of giving them a really long time to respond. And in the meantime, this guy found another job. Now, what did we do the very next year? We give them 1 week to reply. And we play on their risk aversion, right? So you guys know about risk aversion? I'm concerned that I'm not going to have a job, so I will take this one. And we've done much better at landing people since we started playing on their risk aversion. Oh yeah, everybody plays games, right? People are scumbags. Okay, any other questions? Okay, let's see what else we got here. An option is considered in the money if exercising the option would result in a positive payoff. So for instance, a call option allows me to buy a stock for $20 per share. The stock is currently at $25 per share. So I can exercise the option, buy the shares for 20 and then turn around and sell them for 25, resulting in a positive payoff. Therefore, we would say that option was in the money. If the stock price was equal to the exercise price, we might say it was at the money. And if the stock price is such that it would be a negative payoff, then we call that an out of the money option. Would you ever want to exercise an out of the money option? Absolutely not. Here's the weirdest thing. The first option, and I sold covered calls, and I'll tell you what that means here, but the first options contract I ever sold, the person actually exercised the options contract even though they could have gotten the stock cheaper in the open market. How dumb. If you're that dumb, you don't need to be playing in the options markets. Okay. Now, do I know who that was? When you sell stock, do you know who you're selling it to? No. When you get one of these option things, you don't know who the other end of it is. Okay, so let's talk about a call option. You may remember callable bonds. It's the same idea. The option's the same. Call options give the holder the right, but not the obligation to buy a given quantity of some asset on or before some time in the future at prices agreed upon today. Now, we are talking about stock options, but you can actually have other kinds of options too. My derivatives professor at University of Missouri, he was on the board for building this Catholic high school, but they didn't quite have their money together, but they found this plot of land that they really, really wanted. And so what he did was they bought a call option on that land that gave them the right but not the obligation to buy that land at a pre-agreed upon price on or before a certain date. And so we're going to be talking about stocks, but you could do call options on lots of different things. Now, something you need to know for stocks, when you buy or sell options, it's always in contracts of 100 shares. In stocks, when you buy or sell options, it's always for contracts that cover 100 shares. This is very important for you to know. Here's why. What if you decided you wanted to have options for 100 shares and you go out and you place an order for 100 call options? How many shares are you actually getting call options for? 10,000, because 100 times 100 is 10,000. So be careful. By the way, I came really close to placing an order like that one time, and I'm so grateful that at the last minute I remembered that each contract covers 100 shares. Okay, so when we are exercising a call option, we say we are calling in the asset. We're calling in the asset. So in other words, we are forcing the other party to sell that asset. We're buying it. We call that calling it in. Questions so far? Okay, now let's talk about call option pricing at expiry. Now, at expiry means on that expiration date. And on that expiration date, we're going to see that the only value in the option is that difference between the stock price and the exercise price. At expiry, of course, an American call option is worth exactly the same as a European option because there is no time left on them. If the call is in the money, it's worth the stock price minus the exercise price. Remember that for a call option, it's giving me the right but not the obligation to pay, let's say, $15 for these shares. If the stock is currently trading at 22, we are in the money by $7. So that's stock price minus exercise price. But what if for that same option the stock price was now $12? That stock price minus exercise price would be negative. Now, we are not going to exercise, unless we're an idiot, we're not going to exercise an option with a negative payoff. So we say that the value of the call is the maximum of either the stock price minus the exercise price, or 0. The call option can never have a value less than 0. Any questions so far? By the way, here we're using S sub t to represent the stock price at times t, which is a little confusing because you may be thinking of strike st, but now it's the stock price at time t. E is the exercise price. We could also put a K in there if that made you feel better. Questions?
So is American and European like terms for it, or is that more or less only for American European stock exchanges?
Oh, no. He's got a great point here. You can buy an American style option on a Chinese exchange. You could buy a European style option on a Brazilian exchange. We could just call them type A and type B. Why are they called that? Because that's where they originated.
So it's like universal terms
Yeah.
in like international trade as well.
Exactly. Kind of like French fries. Oh, wait a minute. No, French fries aren't like that.
So if you're getting a great price on the option, would you go ahead and cash it in early instead of waiting for the expiry?
Okay, so he's asking a good question. If you had, so right now, it's really in the money, really, really high in the money. I'm going to show you that it is actually better at that point not to exercise the option, but to sell it to someone else. Because the option is going to have two kinds of value. It's going to have that intrinsic value, which is what we've got right here, and then it's going to have some speculative value, kind of like a lottery ticket kind of feel to it. And we'll talk about where that comes from and why it is. Questions? Okay, we are going to be talking about payoffs and profits. And the payoff is just the money that happens when you exercise it. The profit is that minus the option premium. So the option premium is the amount that the buyer or holder of the option spends in order to get this right but not the obligation. Because after all, are you going to give someone the right but not the obligation to force you to do something without getting some money up front? No, you're going to charge them for that. That's called the option premium. Right now, we're just looking at what happens at the expiry when we exercise the option. Okay, here we have an exercise price of 50. This is a call option. If the stock price, that's the horizontal axis, if that stock price is below 50, then the option is worthless. Right? Because if you exercise it, then you actually have a negative payoff. So we're not going to do that because we're not dumb. However, look what happens once we hit the strike price. Now, for every dollar the share price goes up, the payoff of the option goes up by $1. Let me say that one more time. After a certain point here, which is the exercise price, every dollar the share price goes up, the option price goes up $1. This is why options are really popular with speculators. Let's say that I paid $2 for this option. If the stock finishes at 53, then I've got a $3 payoff minus my $2 initial investment. I've actually got like a 50% return there just from the stock price going up by 3. Does that make sense? Now, it's risky though, because what could have happened? The stock price could have fallen down below, and it could have just, like the day you're planning or expiry, it falls to 47, your options expire, and the next day it goes to 57. You just don't know how this is going to go. So what I'm telling you is that buying options is risky unless you're using them as insurance. I'm going to show you how to use them for insurance. Okay, any questions so far? If you are holding a call option, you hope for the stock price to go up or down? Up, and you want it to go up as high as it possibly can. By the way, what is the theoretical maximum stock price? Infinity, right? Okay, now we're going to talk about the call option profits. Call option profits is just where we take the payoff and subtract the option premium. And so we see down here that below 50, your profit is minus 10 because you had a $10 premium that you paid for that option. In fact, that option is not going to be profitable until the exercise price plus premium is achieved in the stock price. You have to get the exercise price plus the option premium in order for you to make a profit. Now, it's real easy to understand why we would exercise this thing at a stock price of 80. Would you exercise it, though, if it were 55? Your instincts say no, but the answer is actually yes. We're going to exercise it if it's anything greater than the strike or exercise price. And here's why. If I exercise this thing at 55, how much money do I lose? $5. If I don't exercise it, how much money do I lose? $10. Does that make sense? We're going to minimize our losses by exercising as long as it's above the exercise price. It's always rational. And this is, of course, on expiry day. Questions?
Does that mean we don't pay the option premium if we don't exercise the option?
No. You've got to pay that premium regardless. This is like insurance premium, right? So I just recently paid the insurance on my car, and 6 months from now I haven't had an accident. Do I call them and say, "Hup, didn't have an accident, can I have a refund?" No. That premium is gone. Once you pay it, it's gone. And the good news is, if you're the person selling the option, once you get that premium, no one can take it away from you. Good question. Other questions?
So both of those are considered out of the money, even though the strike price would be above the exercise price?
As long as the strike price is above the exercise price, it's still considered in the money. The question is it profitable? So in the money, out of the money, it's based on the payoff, not on the profit. Yeah, positive payoff, not profit. Now, if you're on the other side of this trade, if you're the one that sold the call option, then your profit looks exactly the opposite. If you sell the option, you've got a $10 profit right up until it hits 50, and then your profit drops by $1 for every dollar the stock price rises. Now, in theory, and the way to think about this, it's really dangerous to write what we call a naked call. So we're going to have two kinds of, this is as exciting as finance gets here, by the way. Naked and covered. If I write a covered call option, it means that I own the shares. If I write a covered call, it means I own the shares. And so if I get called out, all I have to do is turn over the shares that I own. But some people, crazy people, will write options on stocks they don't own. And here's why that's called naked. That's very dangerous, and here's why. What happens if the stock price goes way high? Say again? So you've got to go out there and basically buy this stock at $115, and then what do you have in return for that? Your $10 premium, right? So at least having the stock in your hands is going to keep you from having to come up with a boatload of money at the time. Now, still in theory, you would have been better off not writing that call because you could have sold the stock for a bunch of money. Now, let me tell you, I'm going to share with you a story about one of my own options deals here. I bought some shares in a company called Gene, G-E-N-E. I don't even know if they're still around. I didn't even know much about them at the time. Here's what I did know about them. They were cheap enough that I could afford to buy 100 shares. So it was $7 a share, so I bought, so it's $700, right? And then I went out and I sold covered calls. And then after they would expire, I would sell another contract, right? And so this is a way to make money on stock that you own, right? So it's like in addition to dividends and whatnot. The only downside, of course, is that you could get called out. Now, I played with this thing for months and months and months. By the way, why were people interested in buying options on this particular firm, call options? The answer is it was a biotech firm, and it was thought that they were on the verge of some sort of breakthrough. And people want to be able to participate in that upside if it happens, but they don't necessarily want to own the stock right now. They didn't want to pay the $7 a share for the stock. And so all I did was I'm giving them the opportunity to get rich if this thing takes off. And in the meantime, they're paying me this premium to do so. So I finally get tired of messing with this stock. And I decide I'm going to sell my 100 shares. And I'm not a greedy man. So I said, if I could get a 200% profit out of this, I would be perfectly happy. And so I put in what's called a limit order. What's a limit order? The stock price has to get up to $21 a share in order for it to go through. And so I put this limit order in, and it kind of, nothing happened, and it expired, and I put in another limit order. I think it was the third one that I get this text message, or not text, it was email, and it said, your shares have sold, and I'm like, woohoo, 200% profit. And then I go look at it, and it actually sold at 22. I'm like, damn, I'm feeling pretty good, right? But then I thought, wait a minute, why would it sell at 22? Undoubtedly, it had to pass 21 on the way to 22. What happened? I went out and looked at the share price. It was at $106. Yeah. This is, and you know, this could have been a story about me selling options with the call, the exercise price of $21 a share, and then having to give up my stock that was worth $106 a share. So it tells you exactly how somewhat dangerous it is to play with this. Now, I was okay because I owned 100 shares, right? But if you wrote a naked call on that stuff and it took off like that, you're going to have to go out and grab 106 times 100, so 10,600 in cash to make that right now. Raise your hand if you can get your hands on $10,600 in cash right now. All right. Are you dealing drugs or something? I don't want to know. Okay. Yeah. So it's really not an easy thing to do. I mean, I've got money, but it's not going to be something that I can get my hands on right away. Okay. So, and by the way, what kind of people are typically writing these naked calls? People who don't have the money to cover themselves if things go terribly wrong. Yes?
Were there any signs that the prices were going to raise that much?
Okay, so here's what drives, thinking back to chapter 6, what drives stock prices? News. There was a news release. They discovered the cure for, I won't say herpes, because we know we still haven't got that cured, but it was something else, right? Something big, and they're like, yeah, they found the cure for whatever, and then the stock price takes off. That was the thing. Now, unless you were sitting there watching at the very moment that that news release came out, there's no way you could beat the professional traders, right? And so that's why these people are buying the call options, because then they don't have to be watching this whole thing. The other thing is, what if you start to see the stock price dramatically creeping up right before the announcement? What is that a sign of?
Insider.
Yeah, insider trading, right? And so you'll see that. Now sometimes it'll just be people making up rumors. And they'll actually be trying to fluff up the market, and then they sell their stock. That's called pump and dump. By the way, that's illegal. So we have another question over here?
Yeah, so like if stock options are given as a form of compensation, so would that make profit and payoff the same? Because there's no premium to the recipient of the stock option.
Yes. So she's got a good question here. What about executive stock options? And the profit and the payoff would be the same, except for the consideration of what it was you had to do in order to get those stock options, right? And that becomes a little fuzzy. And it's actually cheaper for some people than others because some people have nastier bosses than others.
Is your co-option expired before you put the limit orders?
Yeah, so I would not sell the stock if I still had options out there outstanding. Because what would have happened if I had a call option outstanding when that stuff went down and I decided 3 days beforehand to sell the stock? Then I would have gone from being covered to being naked. Good questions.
Do you have to like let them know if it's a covered or naked option when you're selling it?
Is that legal?
What's that?
Is that legal?
It's legal to sell naked options, it's just very stupid. And let's think about this. In order for me to be able to sell options, I had to get what was called a margin account. They went together, the rights and abilities to sell options. Now, if I had one of these situations, immediately, basically, I'm going to be in debt to the broker. By the way, is the broker going to say to the counterparty, never mind, this guy didn't have the money? No. And so they're going to go ahead and make this right for the other party, but then they're going to come after you. Now, the question is, what happens after that? For sure, you're probably going to lose your trading privileges, and then you'll have debt collection. The broker will come after you and whatnot. Oh yeah, it's nasty business. Do not do it. If you hear nothing else today, do not sell naked calls.
This naked calls kind of what happened during the GameStop, AMC boom, where the price was rising, they were trying to buy more, and it just went through the roof.
Yeah, okay, so if you sold a naked call there and the stock price goes up, of course you're in good shape. But then, if the stock price falls below the exercise price, people have to go out there and, wait a minute, let me think about that one.
Well, I'm just curious if it was naked or covered. I mean, I know those call options and stuff, but what kind of...
Yeah, so if you were trying to profit off that, you would be buying calls. And the people selling those calls, if they were smart, had... okay, now, and by the way, thinking of options is not as clear as thinking about everything else. It's like trying to read in the mirror, right? Okay, so here's the trick. If I'm selling naked calls, which the kind of people that would be involved in that meme stock crap would be the kind that would sell naked calls, right? And so now it comes time and I get called out because the share price went way above the exercise price. I get called out. What have I got to go do now? I've got to go buy those shares. Now here's the interesting thing. When I have to go out there and buy those shares, what does that do to the share price on the market? It pushes it up even further and makes it even worse for the next poor bastard in line that has been selling naked calls. Does that make sense? Oh yeah. Naked calls, bad. Don't sell them. I know at least one of you will. Hopefully you don't learn the lesson the hot stove way. Oh, by the way, let me tell you about, before I forget, about my option trading history. I decided to start trading options and I finally get authorized to do so. And on Monday, I buy some calls in my own company, because of course I think I have good information on my own company. And over the next 2 days, I made 55% return. And so I got out. And you know what my conclusion from that was? I'm brilliant, right? I'm like, yeah. Exactly. And then I'm like, And so I'm playing around with it, and I'm like, the next week, I'm like, you know what? I'll bet I could do that again. Lost every single bit of money that I made the first week.
10 times.
What's that?
10 times loss.
Oh, no, but I actually got out. And yeah, I got out, and I just basically walked away with my original with my original money. I didn't. So here's what I'm getting at. If you win, it's not because you are skilled. People always want to attribute their wins to skill. When you were playing football and you lost, did you say, it must have been because of our low skill? What would you say?
They just outbeat us. Yeah, outbeat us.
Oh, well, it's okay. That's actually sounds relatively rational. What most people say is, oh man, it was just bad luck, right? Just bad luck. And this is what we see when people do trading, is that if they have a win, they attribute it to their skill, and if they have a loss, they attribute it to luck. Did you have a question?
Is stocking more such like gambling?
Oh, very good. Okay. So this is actually, so buying individual stocks, I would tell you, is like gambling. Having a diversified portfolio, you are investing. If you are buying individual stocks, now you are gambling. And when you try to juice up the danger with stuff like this, now you're really gambling, right? Oh yeah. Oh yeah. This is dangerous stuff, folks. Let's see, there was one other thing I was going to. Do you have another thought?
I mean, I haven't invested in stocks yet, but I'm kind of interested right now.
Oh yeah, of course you would
Would
be.
you like to share some?
I will give you, here, would you like to know today's hot stock tip? Are you ready? Exchange traded fund that represents the S&P 500. Now, am I guaranteeing you that you'll have a positive return in a year? No. Am I guaranteeing you have a positive return in 5 years? No. Am I guaranteeing you that you will be better off at retirement than you would have been if you didn't? Yes. Now, unless everything goes terribly wrong, in which case all of us are going to be eating worms anyway, right? During the financial crisis, one of my students says, Dr. Haggard, what are you investing in? And I said, beans and ammunition.
Okay, so back to the gym.
Back to the what?
Back to the gym. You selling your call options when you're knowing the stock is about to go off of the speculative news. So you'll buy a put option because you know it's not going to last forever.
Ooh, yeah, so we'll get to that.
Okay.
Yeah. Okay, so when do you buy a call option? When you think the value is going to go up, but you're not sure. When do you buy a put option? When you think the value is going to go down, but you're not sure. So put options give the holder the right, but not the obligation, to sell a given quantity of an asset on or before some time in the future at prices agreed upon today. In other words, if you sell someone a put option, you may end up buying the stock at a higher price than you could go out and buy it in the open market. So let's say that the strike price is $20 a share, and the stock price falls below $20 a share. They can force you to buy the shares at $20 that are only worth $17 in the market today. And so the payoff for the option holder there would be $3 in that case. Now, it would be a $3 loss for you if you wrote that option, because you're out there buying stock at $20 that's only worth 17, right? Okay, when you exercise a put, we say you're putting the asset to someone. Oh yeah, I put that to that person because I don't want that, right? So if you go out and buy a put option, are you hoping for stock prices to go up or down? Yeah, you're hoping for them to go down. Now, a put option you can think of as being insurance. You can think of a put option as being insurance, because if the price falls below that strike price, you are not going to have any losses for the stock price descent from strike price down to, technically, what's the lowest a stock can go to, right? Zero. Now, so therefore, your losses for selling put options have a theoretical limit. you'll never lose more than the strike price minus the premium, right? Because you're going to receive a premium, and then you may end up having to buy this worthless stock at the strike price. So it has a theoretical limit to it. The losses to selling call options has no theoretical limit because share prices could go to infinity. Okay. So let's talk about the value of a put option. It looks a whole lot like the value of a call option, except for stock price and exercise price are reversed. This thing is only worthwhile if the exercise price is above the if the exercise price is above the stock price. So the stock price has to be below the exercise price for this thing to have value. If the stock price is above the exercise price, then that first thing is negative. What's the maximum between negative number and zero? Zero. And so the value of this thing is zero if it is not in the money. So let's look at put option payoffs. And the way to think of the put option payoffs is to start at this side of the graph. If the stock price does not fall below the exercise price, then the payoff is zero. But for every dollar that stock price falls below the exercise price, the option payoff increases by $1. Right up to the maximum payoff, which is the strike price. The strike price is the maximum payoff. When would that happen? If the shares lost all value. If the shares lost all value, that's when that would be worth its maximum of $50. Let's talk about the profits. When you buy a put, you have to pay the premium here, $10 in this case. And so your profit is minus 10 right down until we hit 50. And then that profit goes up $1 for every dollar in or decrease in the stock price. Now, we know that if we exercise it at 40 or below, and by the way, why is it 40? It's 50 minus the $10 premium. If we exercise below 40, we know it's profitable, but would we exercise this thing at 45? Yes, why?
Because if you didn't exercise it, you'd be out the 10 from the premium.
Exactly. If you didn't exercise it, you would be out the 10. If you do exercise it, you're only out 5. So it's the same thinking as the other way. Now, what does it look like going the other way? You would just mirror image that thing, and if you sell the put option, then you would have a $10 profit right down until you hit 50, and then you're going to start losing $1 for every dollar the stock price goes down. You'll break even at 40, and then you're going to have a negative profit after that. Questions?
So can you choose if you're doing covered calls to only sell covered calls?
Say that one more time.
Like if you're selling covered calls, like you're the one writing them, can you choose to either do put or calls?
Oh yeah, you always choose what you're doing. It's not like some sort of put call lottery where they're like, go.
And is that illegal? Is that illegal for anyone in like CEOs and stuff like that?
Oh, so to buy puts and calls?
Sell covered calls. Or
Oh, to
covered
sell.
options.
Okay, so the question is, it's legal for everyone to do these things, unless they are acting on material, non-public information. So, if I am a CEO and I know things are just about to take off, and I go out and buy a bunch of call options, that would be illegal. If I know everything's about to go straight to hell, and I go out and buy a bunch of put options, that would be illegal. By the way, what's more likely for the CEO to know? Things are about to take off or things are about to go straight to hell? Straight to hell. Straight to hell, you can kind of see it coming. The other thing, you're putting your stuff out that you don't know if it's going to take off or not, but you definitely know when you're about to hit a bridge pier with your car, right? I would hope. Questions?
Do members of Congress, do they partake in options a lot?
You know, given how much Nancy makes, I would imagine there's been some, I don't know, but it's easy enough to find out because they have to disclose their trades, right? If she's smart, she's doing it because she's only having to invest the premium amount, not the full share price amount. So let's say that the premium is 1/10 the cost of the stock. She could go out there and buy 10 times as many shares worth of, and get 10 times the gain. Now, she would have to be darn sure that things were gonna, but do you think that she has the kind of information that would allow her to know? Yeah. Why is this legal? I have no idea.
How have they not gotten onto these senators, like whenever they have to trade in, like all the reports and everything like that, but then whenever they have Mark Zuckerberg up, they don't understand Facebook at all. So it's like, are they a genius or not?
You should have saw the TikTok ones.
Like it's sad to watch, but yet they're making all this money.
Oh, okay, so yeah. That's a good question. Is there ever value in playing stupid?
Yes.
Oh, yeah. And do you think that they would play stupid for theatrics?
Still not a good look for them to look
No.
stupid.
Have you seen more stupid dream?
So stupid and crazy are two different things. Questions?
That's supposed to be option profits instead of payoff?
This is put option profits. Does it say payoff there?
Yeah, option payoff on.
Oh, yeah. The vertical axis, he's made a nice call here. It says option payoffs. It should say option profits. Nice catch. How many is that now? 4. Do you know how many he wants now? And if he had 5, do you know how many you'd want? 6. It's the hedonic treadmill. Okay. Now we're getting into the fun stuff. So we already know about the intrinsic value of these options, and that is just the payoff at expiry. That's the intrinsic value. But if we are a ways out from expiry, there is also what's called speculative value. A speculative value. Now the speculative value is based on the chance that the firm shares could go up or down. So there's still a chance that even if this thing's not in the money right now, that it could become in the money. Or if it is in the money, it could become even more in the money. And so there's sort of a lottery ticket kind of mentality that goes along here. There's the intrinsic value plus this kind of time value that's going on here. And we're actually going to look at some real option quotes, and we'll be able to figure out how much is the intrinsic value and how much is the time or speculative value. I should say time value because it's not. Speculative value is greater as time goes out, though. And we'll talk about that too. So I think we've already said this, that the seller or writer of the option has the obligation. They do not have an option. If you sell an option, you no longer have the option. It's the buyer who has the option. But what does the seller receive in exchange? They receive the option premium. Let's see here. Okay, so this is on for selling. And remember we said it's just the mirror image of buying. And so that's why this one looks like the mirror image of this one. And if we looked at the profits, it would just be the mirror image of this for selling. Now, I don't think I actually put that in there, but the idea is that that would be shifted up by the amount of the premium. That's if you want to find the profit, you're just going to shift that whole curve up by the amount of the premium. And this one, if this is just the mirror image of the put option payoffs from here. So by the way, in these derivative markets, it's called a zero-sum game. For every dollar someone makes, someone else has lost a dollar. It's a zero-sum game. Is the stock market a zero-sum game? No, we're actually creating wealth out there. So you could sell me the shares for 10, and then the shares, and maybe you made $2 on that. And then I hold on to them and they go up another 5 because of the value of the underlying company is going up. But that's not the case with options. For every, and futures contracts too, for every dollar that someone makes, someone else loses. So now let's look at these option quotes. And what we need to, there's several things we need to see here. First of all, they're listing calls and puts. And they have, for every strike price and date combination, there is both, bless you, there's both a call and a put. And so we're looking here at IBM stock. The current stock price of IBM at the time that this was snapshotted was 138.25. It would be 138.25 today since we have converted to decimals, but I digress. Okay, so now we've got our strike prices. And notice that it's not the whole continuum of strike prices. It's in increments of $5. And that's true for this stock. Other stocks, it might not be $5. Go ahead.
I just wanted to ask if that applies for the call profit as well, the call profit slide.
Say one more time.
What you was talking about that slide?
Oh,
Does that
did it?
apply for the call profit?
If you see the vertical axis saying payoff and the top says profit, go scratch out the payoff and write profit. Good question. Other questions?
Who decides the strike price?
Okay, so we've got standardized contracts there. The exchange is setting up this stuff, right? And so, in fact, you can see there's some volumes there, but there's also something that's not up here that's open interest. And if the exchange puts together an options contract that no one's interested in, it'll have an outstanding interest of 0, right? So basically, this is the exchange puts this out there, and then people will, the market forces determine the values.
So the volume, is that like the number of like options for sale? Like
That's the number of contracts that have changed hands since yesterday's close, or over the course of the day, right? But so you can have lots of contracts out there, and the number will grow or shrink. By the way, if I've sold a contract and I want to cancel it, all I have to do is buy that contract back, and they cancel out. And so you could actually have the number of contracts growing and shrinking over the life of the contract.
Do options or backwards have another meaning?
Do options? Yes. We'll get to that in a minute. It's very complex in the way that they do, but they do. It's called the Black-Scholes option pricing model. And we're going to see that the risk-free rate and the amount of time that shows up in there is very definitely involved. Okay, now let's talk about this. If we have a call option, the one in red, the stock price is at 138.25, the strike price is 135. Is that in the money or out of the money? It's in the money. What is the intrinsic value of that option? 3.25. How did you get that?
You just subtracted 138.
Yeah, you remember that it's max of stock price minus the exercise price, or 0. Stock price minus exercise price is $3.25. But if you look over here, how much is that call option selling for? Can you guys see that in red?
$4.75.
Yeah, $4.75. Is that the intrinsic value? No, $4.75 minus the $3.25 tells us that this thing has a $1.50 speculative value. It has a $1.50 speculative value. Now, we're going to see that one of the things that determines the speculative value is that as the option expiry gets closer and closer and closer, the speculative value gets to be less and less and less because there's less opportunity for the stock price to either climb higher or drop lower. Okay, now let's take a look over here on the put. By the way, this put is very definitely out of the money, right? It's out of the money by $3.25, and yet it has 13/16 is what you'd have to pay for that. Why does it have a positive value even though the intrinsic value is 0? By the way, the max of minus 325 and 0 is 0. So how much is the speculative value here? It's the entire amount, right? 13/16. If, and you might want to write this down, if an option is out of the money, then the entire option price is from speculative value. If an option is out of the money, the entire option price is speculative value. Because this thing has no intrinsic value, any value it has must be speculative value. Questions?
So if a call option's in the money, the put option's always gonna be out of the
Yep.
money? Okay.
Good question. So she's saying for the same strike price and expiration, if one is in the money, the other's going to always be out of the money. And in fact, it doesn't even have to be the same expiration. As long as they have the same strike price, if one of them is in the money by $15, the other one's going to be out of the money by $15. Yes?
So if the speculative value, like if the put option is out of the money, would it be the difference, like the amount that's out of the money plus this like option premium? Because like for you to get any value out of it, it'd have to recover from being out of the money plus go up
Yeah.
the.
So remember earlier we said that the value of an option at expiry is either 0 or the maximum of this other thing. Well, if the other thing is negative, then that value, that intrinsic value is 0. Yeah. Now, is it less likely that you'll get there? Yes. But we're going to see that that all comes into the Black-Scholes option pricing model. Good question. Other questions? I am shocked you guys are this interested. Okay. I am pleased you guys are this interested. Okay, now, this is going to get to Mr. Salbet's question about the time value of money. And we're actually going to look at something here called put-call parity. Put-call parity. And the idea here is, so this, by the way, this formula at the top, write that on your formula sheet. Put that on your formula sheet. Okay, the idea is this. The value of a put plus the stock price is always going to be equal to the value of a call plus the present value of the exercise price. So there's where your time value of money comes in, the present value of the exercise price. Now, why are we saying that? If I buy a put and the stock, that is going to give me exactly the same payoff as if I buy a call option and loan out money at the risk-free rate in the amount of the exercise price. So here we've got the bond. The value of that bond is E. And if I buy the call option, this is the payoff to the call option. If I add the payoff to the call option to the value of the bond, then basically that just lifts that whole thing up. We can add those two together, and we get the red. So this red is the portfolio payoff for buying a call option and loaning money out at the exercise price, or the exercise price at the risk-free rate. Now, so far, it really doesn't make a lot of sense why we're doing this, except for if we buy the put value, or buy the put option and the stock, when we add those two payoffs together, lo and behold, we end up with exactly that same payoff. And this allows us to say, oh wow, the put plus the stock must be equal to the call plus the present value of the exercise price. Now that is very handy because we can use that information to, if we've got exercise price, call, and put, I can tell you what the stock price is. If I've got any of those things, or if I've got all but one of those things, I can calculate the other one using the magic of algebra, right? If I wanted to find out the value of a put here, what would I do? I would just subtract S sub 0 from both sides. And so I would have C sub 0 plus E over 1 plus R to the T minus S sub 0 is equal to P sub 0. If I wanted to find a call option, I would just subtract E over 1 plus R to the T for both sides. I can mess with that in many different ways. Now, one thing you may see it written like this. And you may see it written like this. This is with continuous compounding. This is with continuous compounding. And this is with no inside the period compounding. Now, the fun thing is, for purposes of multiple choice questions on exams, they're going to come out so close that it's not going to matter one bit. Why do I even bother to tell you this? Because in some of the solutions you may see this, and you just need to understand that this is very similar. Now, which one is technically correct? This one. But for purposes of our class, this approximation works fine. Mr. Sabet.
I was just asking, could we put it as e to the negative r to it's the same?
Yeah. Okay, so he's also saying but if you've played around with algebra enough, you know that that's exactly the same thing. Some of you have your minds blown by that, and I apologize to you for our crappy American algebra education. Questions?
So when you look at stock prices to buy them, do you look at the one on the left or the one on the right?
Okay, when you look at stock prices
So when you want to calculate, like, is it worth it?
Oh,
Yeah.
okay. So let's say this. You could rearrange this formula, right? And you could figure out what the stock price should be based on the current put value, the current call value, and the exercise price. You certainly could. Now, if markets are efficient, what answer will you get? You'll get the exact same answer of the current stock price, right? And what we figured out is that markets are pretty efficient. Should you ever use any formula from my class to examine a stock price and say, wow, that's undervalued, I should buy it? Absolutely not. The most common problem is that you've made a mistake, right? The second most common problem is that the numbers that you're putting in there are not quite right. So yeah, don't do that. And by the way, these option prices, they move all the time just like stock prices. By the time you've done the calculation, yeah, the stock price has moved. What's my investment advice? Okay, now let's talk about valuing options. And we've said that there's the speculative value, but so far we haven't talked about how to calculate that speculative value. And we can look here at the payoffs from a call value, the intrinsic payoffs But what we're going to notice here is that the actual market value is that red curve. It's not the hockey stick. The intrinsic value is that hockey stick. The value of the option in the market is that red line, and the difference between those two lines is the speculative value. Now, how do we know that it's got a shape like that? Well, we've got this Black-Scholes option pricing model that allows us to know how to price these things. By the way, the value of a call has to fall between the maximum of the stock price minus the exercise price and 0, that's at the bottom, and then the stock price itself. The value of a call will never exceed the stock price. So here's the Black-Scholes model. And it teaches us how to value a call option. By the way, these are European options, but it's very similar. In fact, let's just forget that said that. But it's done for European options. Now, this paper comes out in 1973. What also happened in 1973, stock market nerds? I don't recall that. We did have the Arab oil embargo. I do remember that being a cold winter. But that's the same year that the Chicago Board of Options Exchange begins. And so these things happen like almost simultaneously, and I don't think that was by accident. Because now, by the way, before that, you could buy and sell call options, but they were privately negotiated between parties, usually with banks. And the people were kind of guessing at the value. But as soon as we got the Black-Scholes model, we no longer have to guess. Now, here we go. We've got the value of a call option is equal to S. What do you think S is?
Stock price.
Yeah, stock price. Multiplied by, and this is going to be, we're going to calculate this below. And we're going to calculate D1. And D1 is going to give us a Z value from the normal distribution, and we're going to plug that into the normal distribution, and that's going to give us a percentage. There's some other stuff that goes on there, but it's a lot of crazy stuff that goes on there. And then we're going to subtract out the exercise price times e to the minus RT, so you recognize that. And then we're going to multiply that whole thing times n times D2. What is D2? So let's actually walk through D1 and D2. The D1 is the natural log of the stock price over the exercise price plus the risk-free rate plus sigma squared. What do you think sigma squared is?
Variation.
Yes, the variance on the returns of the underlying assets. And so in this case, it would be the variance on the stock return. Divide by 2, close parentheses, times t, divided by the standard deviation. So in other words, just the square root of that variance times the square root of t. And then you take that value and you go to your normal distribution and you plug it into, you find it in the table, and then you've got your number. Now, before you guys start freaking out, am I going to actually ask you to do this? No. I am not going to ask you to do this. By the way, I had to derive this damn thing on my comprehensive exam for PhD school. I couldn't do it today if someone held a gun to my head, but I could then. Okay, back to the story. So the big question about this is, what are the ingredients and how do they impact this speculative value? Well, we see that for the stock price, that's S, if it's a call option, it's going to positively impact the price. So the higher the stock price, the higher the value of a call option. That makes all the sense in the world. And the higher the stock price, the lower the value on the put option. And it's just the opposite for exercise price. By the way, I told you that the Black-Scholes only gives us the value for the call. How would we find the value for the put? Put call parity. Number 5. Okay, we would just use that put call parity. And so it's easy enough. If you've got that call from the Black-Scholes model, now you can use put call parity and figure out what the value of the put option is. Now, interest rate. If interest rates are higher, that pushes up the value of a call, it pushes down the value of a put. But there are a couple of things that impact these in the same way. So, for instance, the volatility in the stock price makes both the call and the put more valuable. Not because of the intrinsic value of the option, but because it juices up that speculative value. So, which stock is more likely to go way high or way low? One that's doing this, or one that's doing this? The second one. Which one of those would it be more valuable for you to buy an option in? Yeah, the second one, right? So the riskier the stock, the riskier the underlying asset, the more valuable that option is. And that's true for both call and put, because we're not looking at intrinsic value, we're looking at speculative value. And then we have the expiration date. The longer the time is until expiry, the more valuable the option is, because you've got a greater chance for that stock price to either break out high or break out on the low side. So we can take that back to the job offer. If the job offer expires in 2 days, it's not as valuable as it would be if it expired in a month. Does that make sense? Because you've got more opportunities over that month to get other job offers. By the way, one of the ways you can transfer value from your potential employer to you is to ask for an extension. They've offered you a job. They told you they need to know by Friday. You say, I need to talk this over with my family over the weekend. Can I have an extension until, ask for next Friday, right? And they'll come back and say, no, we really got to know by Wednesday. Because you've negotiated an extended time on that option, you've actually got some value for you, and it's at the cost of the potential employer, right? Because in the meantime, what might you do? Get a different offer, go somewhere else. Does that make sense? Okay. So that's why we see both the volatility of the stock price and the expiration date. The greater the time to expiry and the greater the volatility, the more valuable those things are. Now, what do I want you to know about the Black-Scholes option pricing model? For once in your life, you do not need to write the equations down on your note sheet. What do you need to write down on your note sheet? These relationships right here. You need to write these relationships right here on your note sheet about stock price, exercise price, interest rate volatility in the stock price and expiration date, impacting the values, how they impact the values of calls and puts. By the way, it was revolutionary when Black-Scholes came up with this, and to know that it actually came down to just these few variables, right? It makes perfect sense. Questions? By the way, a guy, and I forget his name, he actually figured this out in, say, 1960 something. And he started a hedge fund. And he was actually out there making deals with people. He knew what the value of the option should be. They didn't. And so if they undervalued the option, he would buy it. And if they were overvalued, so you can see how he could do that. Made millions and millions of dollars. You know, he had to be the angriest person the day that Black-Scholes published their study. You know, I think we will wait till next time to do the rest of this. Any questions? Thank you for being engaged and interested in options. This is the first class I've ever had that was that very interested.